If you're a day trader, I want you to take a notepad and pen and watch this entire video. So in this video, we're going to be going over support and resistance. One of the most overused topics in trading, overused and overabused, and very few people understand how a support forms and how a resistance forms. So in this video, I'm going to be breaking down support and resistance with order flow. Now, the trick is order flow. Don't trade support and resistance without order flow, because you need to understand what's going on inside of these levels. So for example, right, support flips to resistance and resistance flips to support. So what you're going to see is a support area over here, and vice versa. When we break below, it will then become a resistance area. Now, how can you take this simple logic and apply it to the charts, right? Because the problem I see a lot of traders having is that they don't truly understand where the support is going to be, where the resistance is going to be. So in this video, I'm going to be breaking that down, and I'm going to answer everyone's unanswered questions, which is the best zone to use? Very good question. Now, this is the S&P 500 futures, right? So I'm going to be breaking things down in terms of a 4-pillar approach. Now, the 4-pillar approach is what I want every trader to kind of understand, right? So I'm going to replay the price just till last week on Friday before the crazy news events, right? So if I look at a chart like this, the first thing I'm looking for is I want to see market structure. So what I'm looking for is I'm looking for structural highs, structural lows. I'm looking for structural highs, structural lows, and then our structural highs. So this is our swing low, which is kind of down here. This is our swing low. And so from here, as a trader, how I'm looking at this is I want to basically know where the most recent highs and lows are. So this was obviously the Trump tariff, right? Now from here, if we just kind of break down what happened this week, just by replaying the price, I want every trader to appreciate this. So I've played price back because I want traders to understand our dealing range. So step 1 is market structure. Step 2 is the dealing range. So the dealing range is from this swing high down to this swing low. This is the dealing range. This is the high and low that we are trading within, right? Simple as that. Now we project the fib tool from the swing high down to the swing low, right? Swing high down to the swing low. Notice how I'm not interested in these internal highs and lows. These are internal structures. So basically, you want to be buying in the discount and selling in the premium, right? It's that simple. So how do we determine that? So for example, here, if we look, we have a structural high. I'm just going to label this H. We have a structural low down here. Anything above the 50% is a premium, and anything below that is, of course, a discount. And now from here, once we have these two places in check, the last thing we're looking for is 15-minute fair value gaps, right? How do we do this? So 15-minute fair value gaps. So a couple of things to note. I treat a gap the same way as I would a fair value gap, right? So this is just a gap up in the market. You can treat it like a fair value gap, right? So Monday the 13th was a bank holiday, so I don't trade US bank holidays. I think it's dumb. Notice how we're also at the equilibrium, so there was tons of choppy price action, not very clean to trade at all. But now we come to Tuesday's price action, right? So on Tuesday, let's kind of break down how Tuesday formed. So I took a trade here on Tuesday. I got in long. So why did I get long, right? What was the reasoning behind me getting long, right? So one of my favorite topics in trading, and I've been speaking to a lot of traders about this, is the idea of stacking confluences. So stacking confluences basically means you need 2, 3, 4 things in your favor when you look for a trade, right? Stacking confluences. So on Tuesday, my key level, so we're going to start by looking at key levels, right? So what makes a key level? A key level is a 15-minute fair value gap that is priced in the premium or the discount. Those are 2 confluences right off the bat. We're looking for a 15-minute fair value gap that is in premium or discount. Those are 2 confluences right here. So how am I looking at this price action? So I'm not too interested in the structural highs, structural lows, structural highs. What I'm interested in is this region over here. So this here was the key level, right? So what makes this a key level? It is the last candle before the start of the fair value gap. So we had a fair value gap here, here, and here. I'm just using the candle before the fair value gap, right? So I want every trader to see that. This is my key level. So ideally, we treat this as, I think in ICT they call it a breaker, but I just call it a fair value gap because it is a fair value gap. So when price comes into here, yes, we could see a sell-off, but I'm not really interested in shorting, right? So why am I not interested in shorting? Well, bigger picture. We are in discount, right? Because remember, our structural low is down here, our structural high is up here. We're in the discount, we're below this 50% area. That is step one, right? Step two, or confluence two, is that we fill the gap over here, right? That's the next thing, right? Notice how this gap from here to here, this gap has been filled on Tuesday, right? This was we filled the gap. That is the second thing to kind of look out for. Now, the third thing to look out for, which makes this a very good, I guess, support area, or we don't know it's going to be support just yet. What makes this a good key level is this right here, right? So this is the PO3, and I'm going to change this to the daily candle, right? So for those who have been following some of my previous videos from about a year ago, you will know that I talk about the ICT accumulation in terms of two phases, phase one and phase two manipulation. So what that means specifically is, if I kind of draw this here, when price accumulates in the Asian range and we rally down lower like we have here, this here is a daily opening price, right? So this is New York midnight opening price. So I'm just going to write 0, 0, colon, 0, 0, right? This is the New York midnight opening price. This is kind of when the market resets, if you like. Now from here, what we can see is we are significantly below this daily opening price. Notice how we've taken out the Asian range low in the process. So some people call this the ICT Judah swing, some people call this the low of the day. It is basically the low of the day, or you're anticipating it to be the low of the day. This is another confluence, and I think it's very important to understand, right? So our first confluence, we're in discount. Our second confluence, we filled the gap. Our third confluence is that we are below this daily opening price. It's very simple, right? We are significantly below the daily opening price because of this bearish candle over here. That is confluence number 3. Confluence number 4, which kind of ties into the New York midnight opening price, is accumulation and now manipulation. Accumulation is the Asian range, right? This works across Forex, futures, just about anything. If you're trading the New York session specifically, what you want to understand is that the Asian session will accumulate liquidity. The London session and or the New York session will manipulate. And of course, if you're trading the S&P 500, I want to catch the distribution in the New York session. That is basically how I trade, basically, right? Obviously, the other thing is order flow. We're going to get into that. So if this is your accumulation, this here is the Asian range, this is the accumulation. Now, when price kind of rallies below that, what we see here is the manipulation. Now, this manipulation is essentially the low of the day. People call it, Judah swing, whatever you want to call it. But basically, this is AMD. So we have accumulation, we have manipulation, and now from this key level, which I'll just drag over, we want to catch the distribution. So basically, we are looking to catch the expansion of the day, which was, of course, bullish. So why was it bullish again? So we've swept the Asian range low, we've filled the gap over here, we're below the daily opening price here, we're in discount here. We have a lot of things in our advantage to look for a potential, and the key word is potential, long. Why is it not a guaranteed long, right? So the reason why is because we don't know if buyers are going to be in control. Now this is the thing that catches a lot of traders out. And I want to kind of dissect this just from a 5-minute chart, right? So if I get rid of this now, so this is our level. Now, you don't know if this is going to be a support, a resistance, or just a rangy session. Sorry, you have no idea what the market is going to do here. The only way you can fix that is by using the order flow. So this is the order flow. This is ES on the ATAS platform. And what I'm going to do is I'm going to mark out that same exact level, right? So this is the same level over here, right? So I want every trader to kind of take notes of this and understand how this formed, right? So this key level is very important to understand. So ES had a huge rally up. That was around 66.38 area. And we want to focus on this level. So to do that, we're going to go to a 5-minute chart and we're going to understand what was going on, right? So what you can see, what's interesting here, just from a again a candlestick perspective, is price held as supply. When the market opened here 9:30 Eastern, price held as supply, and then of course we flipped to demand. So we want to focus on, I know I'm using the word supply and demand, support and resistance. You can use those words interchangeably. Now what I mean by that specifically is, if the market holds as resistance, you want to see it break and then hold as support. So I'm going to break down what a resistance zone actually is, right? The words support and resistance have been used by traders for years and probably decades at this point, but few understand why a resistance forms and why a support forms. If you understood why a resistance formed, you would sell more accurately, and if you understood why a support formed, you would buy more accurately, right? Now, why does a resistance form? Because sellers are in control. How do you know sellers are in control? Because aggressive buyers fail. How do you know aggressive buyers fail? Because you read the aggressive buyers and the market moves down when there's buying at the zone. Here's our zone. The reason a resistance forms is because buyers fail, right? So we're going to be breaking this down. So when we came into this zone, what we can see here is a ton of buying, right? We see positive delta inside of the candle. Notice how I'm not looking at the shape of the candle, the size of the candle, the wicks, the bodies. I am looking at the delta inside of the candle. So the last video I made was specifically breaking down the delta. This video kind of is a continuation of that, where when we have positive delta, again, positive delta, notice how we have a bunch of zeros at the top, right? Finished auctions, and then we have finished auctions, and then of course we sell off. Now, a question I've been getting recently from students is, does it matter about which side the finished auction's on? Does it matter that the finished auction in the wick? Does it matter that the finished auction in the body? No, it does not. The only thing you are looking for is, once you establish your key level, right? So notice how this is our key level from TradingView. Notice how we spend the first 5-7 minutes going over what a key level will be. The reason we did that is because when we then go onto the order flow footprint charts, we will know exactly what to look for. So we're not interested in how the delta is behaving in a candle per se. We are interested in the delta at the key level, right, inside of the blue box, essentially, which is essentially the gray box over here. Now, to make this even clearer to people, what we're looking for is in this zone. So this zone is around 66.46 to about 66.36. So let's just say from about 66.42 to 38, basically, if we make a bit slimmer. So this zone, we see aggressive buyers. Now, did they break above the zone? So if we kind of break this down again, what we see here is boom, 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 right? So if we kind of break this down, boom, 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 this is where a lot of your ICT, this is where a lot of your ICT concepts kind of go out the window, because there's no ICT concept that will actually tell you which fair value gap is going to hold, or if you're a price action trader, which line is going to be support and resistance. You don't know. This is what I'm teaching. Now, in this particular region over here, so this is what I'm going to be focusing on. I'm going to highlight this in blue. The reason why is because this is where blue delta is sitting, right? This is where buyers are aggressive here. So if we go to the footprint charts, the ATAS footprint charts, what we can see here, buyers are aggressive, but we're breaking below the zone, right? We broke below once, buyers were aggressive, we broke below again, and then we continue to break down. So what does that tell you? So were these buyers successful? Right? It's that simple. A resistance forms when aggressive buyers fail. That's it. Resistance forms when aggressive buyers fail. Now, that's most people can appreciate that and understand that, right? So market opened, we had a very aggressive sell-off, market open. Now that doesn't mean, so I don't trade the first 5 minutes, so this is 9:30, 9:31, 9:32, 9:33, 4, and then 3, 4, and then whatever it was, right? So this was the first 5 minutes, right? So 30, 35. So I'm not going to trade unless price is at my key level, ever. So when we come back to this key level, this is what I want every trader to understand. We've come back into this key level. There's only two things that can happen. And this is where traders think they have it right, but they have it wrong. And this is what I want to break down for people. The zone can either break down and act as supply or act as resistance, or it can act as support. Those are the only two options you have. Now the third option, if you're unlucky, is this happens, right? Now if this happens and you end up taking a loss, you don't beat yourself up about it, because that's just the market. Sometimes you will get chopped out. Sometimes happened to me on Friday the 17th, right? The end of the week. But when we come into this zone, just by looking at it from a 5-minute perspective, there's only two things that can happen. It can either be a support or a resistance. Right now, we know it's acting as resistance because we've seen evidence of that. We've seen evidence of that because the aggressive buyers have failed. So when we come into this zone over here, we want to see evidence of aggressive buyers failing, right? Now, do we see that? Now, what's going on here? Here we break above the level. So I don't ever take the first tap. I look for the first tap and then start to see a rejection. But we've peaked above this area. We've peaked above this particular level. Now, when we peak above this level, you want to draw a line like this, right? And you want to ask yourself, I will enter if we break above this line, which is what we had over here. So this is an entry point over here. So this is what we want to be focusing on here, right? So for you to take this entry long, 2.5R, for you to take this entry long, what do you need to see specifically? Well, this is what we're going to break down in the order flow footprint charts, right? So here, what was going on was this. So we see in this particular region, what we see is we see buyers here. So this is interesting. I want everyone to pay attention to this. We see, yes, it's a red sorry. Yes, it's a red candle. But what we're seeing is we're seeing buyers inside of a red candle. So what does that mean? So what it means is, imagine you have a red candle like this. So let's just put this up. So imagine you have a red candle like this, and you have buyers inside of the red candle. So it's showing you that the candle is red, but there's buyers inside of that. So what that means is the markets are trying to give you lower prices via the red candle, right? We see the market trying to drive lower prices down, but there's buyers present. So who in this case is being rewarded? Is it the buyers or the sellers? Well, what's interesting, okay, so we break above the level here. Now this is interesting. This, but more importantly, this is interesting, and this is the reason why we had such an aggressive move to the upside. It's this candle here. So this candle here was the rejection wick. Now what's so interesting, and I want to get this up side by side so people can truly understand what was going on. This wick, right, this wick rejection entry is similar to what was going on here. It's the same exact thing. So we see a green candle, so we see higher prices, we break above the zone, right? So this previous resistance over here wasn't acting as resistance, right? So this was resistance. We see signs of resistance failing. Now we want to see if support is truly holding, and so the way we do that is by using our best friend over here. One candle, one 5-minute candle. Let's break this down bar by bar. We're going to look at the wick. So 223 for 167. Right? There's more aggressive sellers than aggressive buyers. Red delta, right? If we look here, we see 353 for 234. More aggressive sellers than aggressive buyers, right? 312 for 166. That's going on over here. All of this is going on over here. Now, if we look over here, we see 142 for 93. More aggressive sellers. 151 for 146. Close, but more aggressive sellers. 234 for 230. More aggressive sellers. Now, at the bottom, 18 for 0, right? Finished auction. This is the reversal. Finished auction over here, 0 on the ask. This tells you that the auction has been wiped out. So this price over here, which is around 66.40, 66.40.2, 66.40, around about here, we see a 0 on the ask. This shows you that aggressive buyers are not even present, right? But we see, despite that, a strong break above the zone. This is evidence that the zone here is acting as support. Why does support form? Because aggressive sellers fail. Aggressive sellers fail, the market breaks higher. This shows you that support is in control of the market. Supply is in control, you're at support. So what you've seen here is actually a shift. What you've seen here is a shift from resistance to support, right? Or supply to demand. That is what you've seen over here. And so just by dissecting one candle's wick, you can understand what was going on inside, right? This is the beauty of it. This is the beauty of order flow. Order flow tells you whether your levels are going to be support or resistance, supply and demand, right? So this is why I want every trader to transition towards using order flow. No matter what your strategy is, support, resistance, supply and demand, even EMAs, it works for just about anything. Now, let's break this down one more time. So this is what also interests me. So when you have a level like this, right? So this was your level from Tuesday, right? So again, what made this level good is that it filled the gap. It swept liquidity, as in the previous day low. It's below the Asian range. It's below the daily opening price. It's in discount. It's got a lot going for it. It is a good zone. It's a good support zone. Again, we know it's a support zone because the order flow told us. That's the reason we know it's a support zone, because order flow told us. Now, if we keep dragging this over to the right, we look at Friday's position. Now, Friday's position, let's go to the 5-minute again. Friday gave multiple trades off this same level, right? So on Monday, we actually had the one trade over here, which went to a pretty big risk to reward, I think. Pretty good risk to reward trade. Now, on Friday, we had the same exact thing. Same level, right? Same everything. Notice how we're in discount, right? We bounced off this level once, twice, 3 times. So this is a support zone. Now again, what makes it a support? Aggressive sellers fail to break below the zone, price breaks above the zone, which means aggressive sellers have failed, passive buyers are in control. That is the reason a support forms or a demand zone forms. I'm going to keep repeating that because it's very important. So if we go now to the chart over here, again, same level, we're going to go now to Friday. So get used to the habit of just dragging your levels over to the right? So now we're going to break this area down, right? So we're going to break down these 2 rejections over here. So we have a rejection here, a second rejection over here. Very good. So again, what's super interesting if we break this down, let's break down the first rejection. Will it let us go to a 1 minute chart? Yes, it will. Okay, so this was the first rejection, which came at around 9:45 Eastern, and we want to kind of understand why this was a good trade, right? So why was this a good trade? So again, super interesting when we break this down. Why did the market hold us support, right? The reason it held us support is because look at this, right? So we see a lot of negative delta. We're only interested in the delta in the zone. Very important. So in the zone, we see negative delta, we see negative delta, we see more negative delta, we see negative delta. So this candle here was a big show, right? So you could have entered the top of this candle here. Now, what's interesting here is that we can see the bottom of the candle was actually filled with aggressive sellers. 220 for 154, 166 for 236. The delta outliers, the negative delta, there's more aggressive sellers than aggressive buyers. But the market was shooting higher. We were rejecting higher. Yes, we had a red candle and we broke above the red candle, right? For those who trade engulfing candles, this is an engulfing candle. But don't trade engulfing candles without understanding the delta at these zones. Super important. So this was a support because aggressive sellers failed to break below the level. Now, if we go to our second rejection, so this was kind of around 11:30 Eastern or just after 11:30 Eastern, we had a similar kind of phenomenon. In fact, in this case, what we saw is we saw 55 for 2. Now, what does 55 for 2 mean? Right, 55 for 2 means that there's significantly more aggressive sellers than buyers. Red delta, look at this candle, massive red delta. Yes, we had a blue delta as well, but we had a finished auction down here, 13 for 0. So there's 13 aggressive sellers and there's no aggressive buyers. This means that sellers were aggressive, but we were unable to break below this initial level, right? This level which held from Tuesday all the way through to Friday, once and then twice. Clean rejection. So again, if we kind of break down this rejection on a 1 minute chart, so, you know, really good trade from discount into premium. This, I guess this second rejection over here. So stop loss below the zone and you would just target the high from New York session. Crazy, right? Really good long over here, right? Very good long. So again, catching these is all about understanding wick rejections. So let's kind of break this down. So here we are. So yeah, crazy trade and even crazier analysis, right? So this here is what we're looking for here. So notice how we have a ton of aggressive sellers, 92 for 90, 192 for 96, 155 for 72, 13 for 0. And then we had an aggressive buyer pop up, which is interesting, which actually drove higher prices. So sellers were unable to break below the fair value gap, right? But buyers were stepping in and breaking above the zone, above the level. So it shows you it's a support because aggressive sellers were failing. Very important. Again, from here, what's interesting, 168 for 71, 1 for 0. So we have finished auctions here and then finished auctions over here. So this shows us that we've seen the market unwilling to trade at the price with aggressive sellers consistently failing, right? This is why the long played out. This is order flow with support and resistance.